Hi there, everybody. It's Ifti from Extreme Returns. Thank you very much for joining me on this financial analysis of one of the stocks I hold. A quick background. I qualified as a chartered management accountant many years ago. I've worked for big blue chip companies. I've also done a stint in recruitment consultancy. And also I then set up my own businesses, estate agency, car hire, to mention just two. I joined the program 2 or 3 months ago, although I've been on Etoro for longer. And my stats are okay-ish, nearly 7% in November, small dip in December, largely because of Ripple. In fact, only because of Ripple, but they've bounced back in the few days we've had in January. Today's the 6th of January and it's doing 3.39%. One of the stocks I've got in my portfolio is a company called ASOS. They're a very interesting British online clothes company. I thought we'd take a deeper delve into ASOS, listed on the London Stock Exchange. So market capitalization is 5.12 billion, and the quality metrics for Stockopedia is 89, value is 33, and momentum is 98. I bought this company for a number of reasons. First of all, let me just explain who they are. They're a global fashion company selling fashion-related content. That's not a very good description, is it? Segments including UK, where they're the biggest, US, EU, and rest of the world. It sells over 85,000 branded own label products through localized mobile and web experiences. They're based in Hampstead, which is just, well, it is part of London. So one of the reasons I bought them is because they are a stock I think that will keep on going up. If you look at how their stock price has increased, didn't do much for a few years, but look from here. It was 167 here, or only 9 there. And then it just kept on climbing and climbing and climbing. They had a big fall in 2014 and started climbing again. As you can see, a fairly volatile stock going up and down quite a lot. However, I think they can regain their highs, 336 at the moment. They're on 52.22. Oh, the high was 7435. I think they've got a long way to go. Return on capital employed, 13%. Return on equity, just under 18. Operating margin is poor, but I think that's because they not only sell their own goods, but other people's as well. If we look at their revenue, it's increased from 1.1 billion pounds in 2015. It's tripled to 3.3 this year, estimates 3.8, next year estimates 4.4. Compound annual growth rate 23%. Any company growing that fast is good. The research shows that the companies whose share prices do very well are those who can organically grow their sales the fastest, and 23% compound annual growth rate is very good. If you look at their net profit, it's just above that level, 25%. That means that the growth is translating into profits. Many companies grow, but don't necessarily grow in terms of profit. So the net profit, modest amount, 36%, 36 million here, went down, went up, and has been going up except for this dip in 2019. Their estimates say that they're going to be pretty much the same this year as they were last year, but go up significantly next year. Operating margin in this business is low. I'd like to see them increase it. You can do that a number of ways. The mixture of products which you sell, you can do it also by increasing prices, reducing costs. Return on capital employed has been going all over the place. It was 22%, 19, 27, 23, 7, 13. In spite of that, still ahead, especially because of the jump between 2019 and 2020. Free cash flow. Now, this is an interesting metric. I mean, people who watch my videos know how much importance I give to this. Free cash flow per share is all of the cash left over after they pay for everything. So it was positive in 2015, 2016, but for 3 years, it was negative, which is not good. Interestingly enough, their net profits in those years were high. So they're showing profit of a combined amount of 140, 170 million odd pounds. However, they are burning through cash. One of the reasons is that they're spending much more on their infrastructure, CapEx, capital expenditure. You can see how much they're spending per share. It was only 61 pence here, but it more than tripled in 2017 and kept on going up in 2018. Didn't come down very much in 2019. And that accounts for all of the cash outflow. But now, a lot of, those 3 years of investments have paid off. And look at that. The free cash flow per share is 318, whereas before they started spending all that money, it was 2016. In terms of the amount of cash they have in the bank, it is now 408 million. It's been growing at a rate of 28% per year, compound average. And if you look at before they were spending all this money, it was very healthy. Then I guess it went down to zero because they were borrowing money. And there you can see net debt. It was cash positive before, and then net debt goes up to 75 million. However, very quickly, they're able to recover that position and pay off all their debts. Value-wise, we're looking at 33. So the PE ratio is 40, which is very expensive for a UK company. In fact, it's very expensive for any company. If you look at the metrics, just remember that number 40. The S&P is less than half that. The FTSE is even lower at just below 17. So 17 PE for the whole of the UK market, and ASOS has got more than double that. On that metric alone, it's very expensive. However, one important factor to consider is that I think we should be looking at PE ratios not from an accounting perspective, but from a cash flow perspective, and that's 17.9, much better. In spite of that, the PEG ratio, which is very important. Now, what that is the same as the PE ratio. PE ratio is price earnings ratio. It shows you how expensive a company is. Price earnings growth ratio is slightly different because it takes into account the future 1 or 2 years. I think it's 12 months in this case, because most companies have to give estimates in the next year. So when you look at the PEG ratio, now you can't compare that number with that number. It's because the ratio is different. Anything below 1 is cheap. Anything, well, the higher it is, the worse it is. And here it's really bad. I think that this company, in spite of the financial metrics, is still good value. And the reason was because I was just showing you earlier on the way the price goes up and down quite a lot. So we're buying it here. I think more and more people will start buying online, especially things like clothes. And that market cap is very reasonable when you compare to other companies as well. Some of them I have in my portfolio. Momentum is 98, which means at the moment the price is going up. And I think that's because it took a big dip here at the pandemic, but it's been climbing steadily at 1 year. It's been climbing steadily. 1 month relative strength is 14.4%. That means it's outperforming the market, but it's not outperforming the market if you look at a 3-month basis. However, if you look at longer term basis of 6 months and 1 year, it is easily outperforming the market. Moving averages, the trend is upwards for both 50 days and 200 days. So although it's something, I mean, the other thing I like to look at is the F score. And this is an academic called Joseph Piotrowski. He looked at asking very few simple but very powerful questions. Is the company making a profit? Tick. Is it generating cash? Tick. Is it making more cash than it's reporting as profit? Tick. Is it more profitable than it was last year? Tick. Is the long-term debt reducing or stable? That says no. We'll come back to that in just one moment. That's interesting. Is it increasing its ability to pay short-term debts? Yes. Is the company trading without having to raise funds from shareholders? No. I think that's because of the pandemic. And there you go. That must have been because of the pandemic as well. Is its pricing power improving, cost reducing? Again, pandemic related. Is it more productive than last year? No. So a lot of these will go because of the pandemic. And I think this is a good recovery play. And it's online. It's in a good sector, which is fashion. And I think people will spend more and more money on clothes as time goes. So that's me. My name is Iftikharuddin, or Ifti, you can call me. I'm from Extreme Returns. My stats are reasonable. Please do subscribe. And if you have $200 in your account, please copy me. That would be really, really, really appreciated. And if you have another $200, I'm trying to help my wife as well. She's Asian Tigers. Her name is Adiba. Her stats are even better than mine. She got 3.61 in December, and she's at over 2% this year to date. And she invests in companies purely in the Far East. So she's got an ETF for India, Japan, Taiwan. She invests in some companies which are doing really well. And some of these take leaning are really interesting companies, which I think have got a very bright future. So that's us, husband and wife on eToro, trying to build our business. Thank you very much for listening in, and hope to see you guys very, very soon. Take care and bye.